One thing many businesses have been asking for in the wake of COVID-19 is trying to be able to plan for the increased amount of uncertainty. For example, owners being able to see, will I be able to survive if my sales continue to be 30% lower? How will that affect my ability to pay not only my employees, but also myself? Hello everyone, my name is Connor Hilton.
My name is Nathan Smith.
I hope you're well and getting through this uncertain time. So as some of you may have read, this webinar will be on cash flow forecasting and the importance of it. It is now more important than ever to monitor your cash flow accurately. And even though some businesses may be in a good position with the cash flow boost subsidy, JobKeeper payments, rent and loan freezes, do you know what your business will be looking like after these subsidies end? Will you be in a position to continue paying your rent, loans and wages at 100% capacity? What does your cash position look like in 3, 6 or even 12 months time? I've always been an advocate of doing cash flows and three-way forecasts to not only understand where your business is at today, but where it is going, so that you can do scenario planning and understanding if you can pull certain levers, what that does to the cash flow of your business. So at the end of this presentation, you'll know how to start your cash flow, how to improve your position, and also the types of reporting you can utilize to keep track of your progress, and how all this ties cash flow forecasting together to help grow your business. So I just had a little question for everyone before we start. Just answer it in your head. How many people actually monitor a cash position, and how many people know what your business will be looking like after these subsidies end? If you kind of don't know or gave a half-hearted yes, I would say this PowerPoint or this presentation will be a lot of benefit to you. As I said, I'm Connor Hilton. I'm an accountant at Power Tynan. However, have a focus on business improvement and strategy, essentially helping businesses understand where they are now, where they want to get to, and bridging the gap between that.
And I'm Nathan Smith. I'm a software engineer at PT 2.0, which is Power Tynan's technology consulting company. A large part of what we do is create automated reports to provide real-time business critical information to help decision making. I'll turn back to Connor now to tell you all the ways that Power Tynan are here to help our clients.
So Power Tynan are traditionally an accounting firm, however have evolved into much more. We help service clients holistically, whether it being their accounting needs, their financial planning needs, leasing and finance, superannuation, business strategy and audit. We have a wide range of business partners from down south in Victoria up to Weipa, as well as New Zealand, which we utilise to help overcome your issues or challenges. We always strive to challenge you and question the status quo by building strong relationships built on trust. So what are we going to be talking about today? First of all, we'll be talking about the importance of managing your cash, what it's about, where to start, then go into how to improve your position through a waste order or profit improvement process. And then lastly, go into the reporting side of things to hold yourself accountable. So some of you may have heard this before, cash is king, but what does it actually mean? Cash is to a business like oxygen is to humans. They need it to live. So if you look at your profit and loss, you can see a profit of say 40 grand, but where has that 40 grand gone, as your bank account doesn't have 40 grand in it? There are many outgoings that are not listed on the profit and loss, such as loans, ATO payments, are just some of them. So just looking at your profit and loss is not always telling you the full picture. So as you can see on this picture here, you can see that there was a net profit of 870,000. There was an income tax payment of 246,000. Down the bottom further, you can see payments towards liabilities, so loans of 112,000. They sold some assets though, which brought their cash position up a little bit. But then the owners have also taken out 640,000 from the business. So the net cash position is actually negative 100 grand. So as you can see, there's a huge difference between what their net profit is to what their net cash position is. There's a lot of different factors pulling within that net profit figure or net cash position. So before we delve into how to forecast out your cash position, I just want to delve into the different stages a business can be in regarding their cash flow. First of all, first stage that your business will be in is putting personal cash into the business. Second stage will be the business is nearly self-sufficient. Third stage, it's fully self-sufficient, paying for all of its expenses and also paying for some of your personal expenses. Fourth stage is all business and personal expenses are paid out of the business's cash flow. And lastly, the last stage is the expansion stage, which is, obviously you want to be in stages 4 and 5 is ideal. And having a strong grasp of your cash position as a business is important to understanding which stage you are at. So I understand managing cash and knowing which stage you're at can be a daunting task. However, without proper cash management, businesses never have a true grasp of their cash position, and thus where their business and business owners are at financially. So where do you start? So I usually start by going to your cash book file and using your profit and loss and using those exact accounts to start mapping out your future sales and expenses. This way, it's easy to track your actuals versus your budget, your forecasted budget. So at the start tracking out your sales. So know the seasonality of your sales is very important. Some businesses might have a slow January as people are still on holidays or whatever it may be. So you might have a dip in sales in January and then they start to increase in, say, March or so. You start mapping out your sales on a monthly basis. And then when will you actually receive the cash that you sent out for the invoices? When does the cash come into your bank account? So one thing that a lot of businesses struggle with is the concept of debtors. Essentially, debtors is you send out a 50 grand invoice, but you don't actually receive that 50 grand in the month that you sent it out. So if it sent out 50 grand and you only receive 20, that's 30 grand that isn't in your bank account that you originally planned for. So that's the concept of debtors. So that's another important thing to consider when doing your cash flow. And then start looking at your expenses when they fall due. So again, the same concept of sales. Know the seasonality of your expenses. You might have monthly subscriptions, yearly registration fees, all that sort of stuff. Start mapping them out month in, month out. And again, when do your expenses fall due? After that, start having a look at your other cash items. So loan payments, motor vehicle loans, that sort of thing, BAS and ATO payments, and even any personal expenses or personal drawings that you bring out of the business. So these three factors, income, expenses, and cash items, start to form a strong and accurate cash flow forecast. Here's an example of one I've done earlier. So as you can see, there's the income and sales at the top there for each month. There's your cost of sales and also operating expenses further down. And you've got your net profit for each month at the end of there. And on the right-hand side, I actually got the cash side of things. So you got your opening bank, your income received, which includes a bit of JobKeeper as well, less your expenses paid. So as you can see, I've got the expenses, you've got your loan payments, you've got pays your withholding towards the ATO, and also GST payments. So as you can see in the net profit, they're making a bit of profit each month. However, you can see in the bank balance, it's actually decreasing month in, month out because these loan repayments that aren't in your profit and loss, but are still going out of your bank account, actually having a significant effect on your cash position. So at the end of all this, a lot of business owners often ask themselves is, how do I increase my closing cash position? or even net profit. Something we do with clients is go through a profit improvement or waste audit process. So studies have shown that 30% of operating expenses can be waste. And to start to show where these wastes are, we go through a waste audit. So the 5 steps to removing waste, as you can see, audit, prioritize, team, measure the outcome, and repeat, which is every 6 to 12 months. So going through the audit stage, this is analysing where the wastes are in regards to the 7 wastes that it can be in your business. And I will touch on the 7 wastes shortly. Next is prioritising. So get your top 3 wastes that you want to eliminate and how to eliminate them by using a 1-page plan to hold you accountable, which again, I will show you later. Organise your team to get them to focus on each waste, and then start to measure the outcome to ensure that this waste audit process is actually improving your position and actually working. And then repeat. So to continually improve on your business, this should be repeated every 6 to 12 months for continual improvement. So as I said, the 7 wastes that are in a business: overproduction, waiting, transporting, inappropriate processing, inventory, motions, and defects. So overproduction is producing more than what is needed before it is required. Example could be a cafe that's cooking more food than what is required and them throwing out all this food that they spent money on to bring in, but actually didn't get any sales on it. Waiting, so where waiting occurs between the steps in a process, such as waiting for the delivery of components or patients waiting in a room. Transporting, transport between stages in a process, such as pretty basic example, sending a letter rather than an email. Inappropriate processing, using the right tool, process, or person is being used for the job. One thing that a lot of people we see in businesses is multiple approval levels for a small spending request, or another thing that's quite common is entering the same data in more than one place. Inventory, unnecessary inventory or work in progress, cabinets full of office supplies in your office, or unused or rarely used equipment. Motions, unnecessary motions, and poor ergonomics in the workplace. Unnecessary meetings, which I'm sure everyone's been a part of, or poorly structured or disorganized workspaces. And lastly is rework or delays with a product, service, or process, such as incorrect data entry or broken parts or software bugs, quite common as well. So once you've identified the waste in your business using the 7 wastes, you have to understand the 30% that's going to give you 80% of the benefit if you cut those wastes down. So essentially, your top 3 wastes that you can cut down, which will give your business the biggest benefit. So identify those 3 wastes, and then start to put some strategies around how to actually cut those wastes. So something that we use with the clients is called a 1-page plan. So essentially it records where you are now with the waste in your business and your profit in your business, where you want to get to, and then strategies and actions to actually cut down those top 3 wastes that you've identified. This is important because it actually shows the strategies and actions to cut down those wastes, as well as who is responsible for those actions and when they're going to be done by. This 1-page plan shows everyone in the business where the business is at that moment, what the next steps are, and also hold people accountable so people know when things are going to be done by. We've found this really helpful when putting strategies within a business, and it's very imperative to actually start moving your business forward and making sure those wastes are actually cut and start improving your cash position. So once you have your cash flow forecast and you have the strategies and figures you want to improve with your waste audit, it's pretty imperative to start to tie all this together with strong reporting so you can track your progress. So I'll just hand over to Nathan, and he will show you these reports that we can utilize.
Thanks, Connor. Okay, so now that you've finished your profit improvement process that Connor has just been talking about, hopefully one of the steps is actually to come up with a budget. So as Connor mentioned, there'll be a profit and loss as well as some cash items that need to flow into your budget around your loan repayments and stuff like that. So, and if you're doing it in something like Excel, we can use it in combination with your actuals out of, say, Xero, to give you some real-time reports to help you run the business. Okay, so this report here is showing currently our profit and loss. It is comparing our actuals. Currently we're looking at the financial year 2020, just in the quarter ending in June. So we can see here our actuals in the far left corner, percent of our sales, our target, which we've come up with as part of our budget, what our target's percent of sales was, and then any variance in our target to actuals. So this probably isn't an uncommon looking profit and loss where sales is down a fair bit in this last quarter of the financial year. So that's down around about 40%. And the cost of goods sold is also down around 40%. So they are so far they've made a $460,000 gross profit, but they were targeting to make $800,000. Coupled with that, they've had some savings across most of their expenses. So their occupancy, so their rent, they've got some rent relief. Their employment is down a fair bit. And you can see here that they have also got a bit of a boost from the JobKeeper, so 42 grand. So all of that, with all of that considered, they were able to make $160,000 net profit for the quarter so far, which is a little bit below target. So the target was, nearly $250,000. So they were nearly $90,000 behind that. But now let's go and have a look at what's happened to their cash flow, as you can see over the left here, right here. So if I go and have a drill through there, you'll notice this visual from Connor's PowerPoint from before. So we're looking here, they've had like I said, $160,000 odd net profit. We can add back in their non-cash expenses, such as their depreciation of motor vehicles and stuff. Now they've received $300,000 worth of cash injection from debtors. So that can happen for one of two reasons. One, their customers are paying faster, or two, sales have decreased. So the receipts have caught up a bit to the actual sales. Obviously, if it's due to people paying faster, that's a really good thing. If it's due to sales falling, that's obviously not so good. Their stock hasn't really moved at all this quarter, but they've been able to pay their creditors, and also they've had a decrease in their cost of goods sold. So that's probably affected that a little bit too. They've had to pay things like GST and super. They've sold a few fixed assets, so that might be a motor vehicle or something like that. They're able to pay the owners $70,000 and pay back about $9,000 worth of loans. After all of that, they had a net cash flow of $244,000. So their bank account has actually increased this quarter, even though their profit and loss was wasn't showing bad results, but it wasn't showing as good as they were budgeting for. Okay, so what does the future look like now? The bank account looks good, but we know that the sales has been down, which is probably going to lead to cash tightening up in the near future. So let's go and have a bit of a look at their cash flow forecast. Okay, so I've got, I can expand this out to show 12 months worth of budgeting and what the cash balance will look like as up until the end of June next year. So the black line is what the cash balance was last year, so they were fairly high into overdraft. As of the end of last financial year, they got back into the being positive bank cash, and now this year they've started off back in overdraft, and they've come back out of overdraft in March, April. So they're currently sitting with a fair bit of money in the bank, but the way that we're projecting is that they're going to finish the month of June down at negative $140,000. Okay, so what does that mean? That means they're going to have to either go back into overdraft, or they're going to have to relook at how they're going to pay some of their creditors. They're going to have to chase a few debts. They're going to have to maybe pay themselves a little bit less. Bunch of different options, but this is now giving them the ability to say, okay, things are good at the moment, but in 20 days time they may not be. Let's have a bit of a plan. Now the other thing that we can do is say, all right, what's going to happen up until September if our sales remain negative 40% below our budget? So they're 40%. They remain being 40% below budget. So not only with our sales, then we've shown that our cost of goods sold, which I've called our biggest cost of sold beans, that's also going to come down 40%. So now we can see a few different lines coming through here. So regardless, we're going to end up with a tough June. The light green line is our budget's projection, and then the dark green line is what's going to happen if these scenarios play out. So luckily it looks like they're going to stabilize after this over the next quarter. Even in the worst case scenario, they're not going to keep falling down at that rate, but it is still going to be in an overdraft position. So if that's something that they're able to achieve with their bank, then that's all well and good. Otherwise, they're going to need to have to find $100 and something grand to get them through the next quarter. However, so after that quarter, if things continue to be at a negative 40% to target, you can see things are going to go pretty bad pretty quickly, unless if they correct the ship a little bit. They're going to get down to about $1 million in overdraft, which they're probably not going to survive. So before that happens, they need to do some planning if over the next couple of months sales remain so low.
Thanks, Nathan. So to summarize, really cash is the real drive of your business and shows your true financial position where you're at. You can improve your cash position by doing a waste audit on your business. This is to be repeated to ensure continual improvement. And also use strong, accurate reporting to help hold yourself accountable to your actions and your forecast. So a bit of a call to action. By 30 June, have a finished forecast for your next financial year of your income and expenses. So you start off the new financial year on the right foot and start driving your business forward. And of course, if you have any questions at all, please give us a call and we're more than happy to help.